Welcome to The Sound of Economics, the podcast series by Bruegel, the Brussels-based economic think tank. I'm Giuseppe Porcaro, and in this episode, we are going to look at the hot topic of the role of central banks in greening finance and possibly contribute to cutting off carbon emissions. Joining our conversation today, we have Jean Pisani-Ferry, senior scholar at Bruegel, and our non-resident fellows Rebecca Christie and Dirk Schumacher. Hi, Jean. Hi, Rebecca. Hi, Dirk. How are you?
Hi, very well.
Nice to be here.
So nice to be here. And
Dirk, I see you are in a very sunny place.
yeah, exactly. And last week I was still ice skating in the Netherlands, so it is really going up and down. But today's sunny.
Speak about climate change.
Yeah.
So you just written 3 pieces on that very topic of the role of central banks, and actually our listeners will find the links to the 3 articles in the show notes. And I'm really looking forward to the discussion today because you have quite interesting points which I find both complementary and sometimes not necessarily on the same line. So Jean, for example, you started your column by recalling that back in the early 2000s, the ambition of central banks was to be boring, and that the 2008 financial crisis basically dashed that objective. And with central bankers busy fighting fires and ward off emerging threats. And you rightly point out that while some central bankers might still think to go back to the old boring days, you pointed out that recent announcements by the US Federal Reserve and the European Central Bank suggest that there is no going back. And central bankers are now seems to be keen to take on responsibility for policy objectives that they previously shied away from. And in particular, especially what we are going to focus on this episode, tackling climate change. What exactly central banks can do and what they cannot, both in terms of desirability and the mandates that they have. What are the risks? How an activist approach of central banks in fighting the climate emergency correlates with the rest of the policy toolbox, the rest of the institutional setups. I mean, there is quite a lot of meat on the fire, as we would say, to start off our conversation. And I have to admit that I'm no expert on central banking, so I would need your help to have these first big questions explained to our listeners. I don't know who among you want to start off and kick off the conversation.
I can start since you mentioned my piece. You know, it's hard to remember, but let's say 15 years ago, we had inflation somewhere between 1.5 and 2.1% per year. And the central banks were very proud of this achievement and on focusing exclusively on inflation and delivering price stability. And that's why they said, they want to be boring. So we're in a completely different world for a variety of reasons. And so the question you ask is, what can central bank do? And the answer is they can do a lot. I mean, a central bank is extremely powerful as an institution. The question is, what should they do? Should they broaden the scope of objectives they're pursuing, or should they stick to price stability, to which I think most would add financial stability, because that's a lesson from the financial crisis. But should they add other objectives like inclusiveness, like the Fed is doing, tackling inequality, and should they be addressing climate action? So should they contribute as institution to climate action? And it wouldn't be something completely new. We had in the past central banks contributing to development, extending credit, to particular sectors in the name of development. It was not very successful in general. Advanced countries have got rid of this approach, but this is possible. And that's why, we have to start from the recognition that central banks can be powerful.
Dirk, central banks can be powerful, but what they can actually do, or what they are announcing to be willing to do.
It is really the debate going back to the foundation of the European Central Bank. We had a discussion of the narrow central bank, like the Bundesbank, on the price stability, or the broad financial central bank doing also financial stability. So the ECB started off as a narrow central bank in the treaty. In 2008 and 9, they were called to action with the financial crisis. They came to action, and de facto, the financial stability mandate has been added. And I think in the end, central banks play an important role in the economy. So in the 2008-9, the big issue was fighting a financial crisis. The last year has been to fight economic slowdown, and that's behind QE. That's not about inflation fighting. That's about to get against deflation and helping economic growth. And now the big challenge for society is to transition to a low carbon economy, and where the politicians, the government should have the policy primacy, but central banks should chip in just to help out. The government in the lead, but this transition to a low carbon economy is now the big challenge, where central banks can play a role.
Just like central banks are having to do different things than they are used to. Just to jump onto what folks are saying, there's a question of whether a central bank is supposed to look at price stability or financial stability or economic stability, which is the way that most Americans think of what their central bank does and what the ECB has had to do, even when people haven't really wanted that throughout the financial crisis. Europe's politicians have very much had a wait and see, if there's no consensus, do nothing approach when it comes to a lot of spending, a lot of emergency measures. Every emergency backstop put together on the crisis was always calibrated to be as small as possible so as not to. That left a gap, and the central bank had to step in to keep the economy going, to keep the financial system going, to keep inflation wherever they wanted it. And the way that they justified this was saying that whatever there was essential to monetary policy operations. And it turns out that's a very broad way of defining your activity, because you can say, well, if Greece leaves the euro, that would kind of mess up the bond trading system that we use to maintain price stability. Therefore, we have discretion to allow Greece to access these lifelines for its banking system, for example, which can buy us time to let the politicians come up with something. So that's been the way in Europe over the last little while. Now we have a situation with climate change where there's a consensus in Europe that acting together actually is in everyone's interest, as opposed to the US, where there's much more a sense of a climate change debate, and a sense that this really is for politicians and not for technocrats to handle. So the central banks are coming at it from those perspectives as well.
Jean, you wanted to add something on this?
Yeah, I think we had three sort of de facto extensions of the mandate of the central bank in Europe. So we had first the financial crisis and, financial stability as a major objective. It was a mistake not to have it included in the first place in the treaty, or in a very marginal way. So in a way, it was corrected. The second was when Mario Draghi said whatever it takes, and considering that his mandate, the mandate of the ECB, was to safeguard the euro area as a whole. So the stability of the euro area and the existence of the euro area was an implicit mandate of the central bank. And that was, something that wasn't written anywhere, but clearly, being the central bank of the euro area, it had naturally a responsibility in keeping the euro area together. And then we had the pandemic. But the pandemic, I think, was, using extraordinary means for something that's really within the mandate of the central bank traditionally. You had a major shock, you had a risk of collapse, you had a collapse actually, and the collapse was a threat to macro stability and a threat to price stability. So that was completely within the mandate. The question was that to do that, the central bank did much more than usual. It started de facto supporting the action by governments, which was, traditionally considered something they shouldn't do. Now, climate change is something really different, because climate change, in principle, that's a very long-term goal that belongs to the remit of the government. Economists would say, start by pricing carbon in the right way, do the public investment that are needed, have the regulation in place that need to be put in place, and all that is within the remit of the government. So the central bank is a sort of unlikely player in this field. And I think the central banks are doing it, first because they consider It's a societal objective. They have to play their part. Second, because they feel that the governments are not doing enough. So they've got to do something because the governments are not doing what they should do. And third, perhaps also for political reasons, because they feel not doing it would be considered by public opinion a failure of the central bank. So they want sort of also to gain the support of public opinion.
Right, but let's talk about what doing it is, because the Fed is making some very polite noises and joining the task forces and being part of the international community. But the Federal Reserve in the US is not taking the same sort of approach as the ECB and the Bank of England. So there is still very much a debate of how much of this is supportive and how much of this is leadership. And Dirk, I know you've been writing about that. You think the ECB really should be a leader on this, right?
Yeah, the real question is license to operate. And one way of thinking about climate is that the government has a central role and carbon pricing will solve it. An alternative way of thinking is the Sustainable Development Goals agenda, which is broader, can only be achieved if everybody, private individuals, citizens, business, and government agencies each play their role. And you see business embracing climate change, going beyond regulations to keep the license to operate, to have young students coming to work for them because they have a social license to operate in their business mission. And I see the same with central banking. So I think we are aligned that the lead on policy is with the government, but each society, including the central bank, can play its role, not as the leader, but its role in getting there. And one technical point, it is really strange, just as it happens to be that high carbon companies, like all companies, issue more corporate bonds than low carbon companies, that central banks are just buying corporate bonds of brown companies. And that is really going against government policy. That's really going against what we try to achieve.
It's so interesting that you think it's so clear cut that it's going against government policy. Because I don't see that, especially not given the debate over asset allocation. The governments aren't saying we want to eliminate market access for these fossil fuel companies. The governments aren't saying we want to shut these people down. They're saying, well, we want to encourage alternatives. But I don't see a policy mandate to exclude fossil fuel companies from financial markets. And indeed, we've seen in the US that when they get too isolated in too many ways, disaster can strike for the people. And that's pretty unpopular if the power companies can't keep the existing infrastructure going.
Dirk, before giving you the floor back, thank you, Rebecca, for this observation. I would like to understand a little bit more. You just said that there is the composition of the brown companies that are invested in by the central banks is disproportionate. Comparing to what? I mean, to understand a little bit more the argument, because I see Rebecca question, but I would like to understand exactly what we are speaking about, also for our listeners.
So the idea of the central bank is that supporting the economy in general, and then they take a proportional share in corporate bonds, what is on the market. As it happens to be, high carbon companies are more capital intensive, like utilities, car makers, big oil companies, and a lot of low carbon companies, like services companies, like consultants, they don't issue corporate bonds because they don't need capital. So if you go to the market, you find the carbon bias in the available corporate bonds. And by just buying the market, a proportion of it, you happen to support the brown part of the economy more than average.
But it's not really more than average. It's the same as the market supports the whole thing. I mean, you're not pushing the average, you're just accepting the status quo.
Yeah, but if we think that the idea is that we need a society and transition to a low carbon economy, we are not getting there by financing the status quo. And I'm against exclusion, because I think that's for government to decide what should be excluded or included. That are really sector policies. But I'm saying if we want to achieve a transition, we do less, not zero, but less in high carbon and more in low carbon. So just tilting the other side and not exclusion, because I think that are really policy decisions to say this sector is wrong and that sector is right. I agree with Sean. Then we go back to the old credit allocation of the central bank. And let's be honest, central bankers are not elected and they are not in the market, so they're not the best one to make these choices. That is a recipe for disaster, exclusions.
Jean.
Let's go to what central banks are actually saying to justify what they do or what they're considering doing. One argument is just price stability or the sort of traditional mandate. Then you're saying there's a way in which climate change may influence price stability, but that's very remote, and there is no particular call for action that results from this type of situation at present. Second, and that was McCartney, then the governor of the Bank of England, said in 2015, he said, there's a financial risk. And as a supervisor, as an institution in charge of financial stability, the central bank should warn against this risk and say, your assets, your brown assets, they will become stranded assets. They will have no value. So that's something you should take into consideration within the financial stability mandate. And that was very clever, because that was a very good way of saying, climate change is part of the mandate because it impacts financial stability. Now, that's right. The problem is, in order to justify an intervention, you have to show that the risk is mispriced by the market, which is not completely obvious. And then you have to also consider the opposite risk. The opposite risk is that a government tells company, I'm going to raise the price of carbon. Invest in green technologies, because these technologies are going to be profitable when the price of carbon reaches 100 euros or 200 euros per ton. And that companies invest and the government does not deliver because it doesn't, want to confront public opinion and the consequences of raising the price of carbon. And that's the opposite risk. That means in the name of financial stability, you would have to tell companies, do not invest too much, or banks do not lend too much to companies that are exposed to this political risk. So I think it's a very clever move, but it's a move that, it's not implemented in a fully consistent way. If you think through, there are risks on both sides. And then the third reason is the one we've mentioned before, to say central banks have a duty to support the general policy of decarbonization, which is a very different argument, which means, for example, I'm going to take the collateral that banks post with the central banks when they give credit, when they want to get access to liquidity. So they post a particular credit to a company. And if it's a brown company, I'm going to apply a haircut, because I'm going to tell the banks, I don't want to favor, I want to disfavor this type of credit. But that's credit allocation. And that's the kind of thing that, was separated from central banking some decades ago, when it was decided that central banking had to apply exclusively to the control of macroeconomic variables. So perhaps government should tell central banks do that. I'm not excluding it at all, because I think the emergency of climate change requires, action on all fronts. But the difficulty was for the central bank to do it by itself without having received a mandate.
So to me, I think the question here is not whether the central banks should act or not act for this bigger society goal. It's like, what would be the most oculate and strategic way of doing it within their mandates, and whether somehow, this is also one question that stems from what Dirk just said, whether for example, the ECB should keep on accommodating corporate bonds and bank loans of high carbon companies as collateral, or should they reduce them? I mean, like how this balance, this tilting would actually work, on which kind of direction, how you push on one direction or the other.
I think the key element where we all agree on that we don't do it by sector, because I think the old credit allocation model was that you identify sectors which need more credit and sectors which need less credit. I'm really against that, because no skills at central banks, but also that's not their mandate. I would say that the transition to a low carbon economy is a macro transition. And I agree that would be helpful if the European Parliament and the European Council state that this is an overriding objective of the EU, and de facto it is, because that is now the key priority of the current Commission, the Green Deal. And how to do it, Gisep, is So we don't want to exclude or include, because that's really political decisions. We just say we have now a bias towards brown, just that happens to be how the corporate bond market and the bank loans are given. That's an allocation. So we just do less of the brown and more of the cream assets. And that has to balance, because on average, they buy the same amount of assets. Dus for example, you buy 30% less brown bonds and 30% more bonds of cream companies. So that's the idea.
That is asset allocation. I mean, you just said you very strong with picking winners and losers, and then you laid out a strategy for picking winners and losers.
No.
What side are you on?
This is not about sectors or companies. It's about carbon emissions. So you select them on carbon emissions. So you don't select them on other, because the overriding goal is to reduce carbon emissions. So you select.
So then you're outsourcing. You're outsourcing to the political body that decides how to measure carbon emissions, and you're outsourcing to, an ETS system that, from what I see, is still under a lot of debate as to how much it's really capturing the greenhouse gas emissions into the economy because of what it mentions. I'm interested that you mentioned, Jean, political risk, because that's certainly outside the EU what people are looking at when you talk about measuring financial stability as exposed to climate. They're not talking about if the Earth warms by 2 degrees, that banks will somehow become riskier. They're talking about if governments become more aggressive about decarbonization, then banks will be exposed to the transition risks as the winners and losers get picked. That's an interesting distinction to me. And that also says to me, we need to be careful talking about the central banks. We know that central banks around the world have to backstop their currencies, whether it's Japan, whether it's the UK, whether it's the US, whether it's emerging markets, anywhere. There isn't a consensus like that in Basel about the central banks and decarbonization. In fact, the work, as I understand it, that's most advanced in Basel is this Task Force for Climate Finance Disclosures, which is industry-led. It's supported by the central banks, but it's not because of the central banks. So when we talk about the obvious central bank role in decarbonization, I think we need to specify that that's the European consensus, maybe, but it's certainly not the global consensus of what a central bank does.
No, but there are many things that central banks can do that are completely unproblematic, like, disclosure, favoring disclosure. That's absolutely, useful and unproblematic. I think that the notion that, there are climate risks and these risks have to be considered, and the implication for, increasing the awareness of financial market participants with climate risk, I think that was very useful. Now, we're speaking of going one step beyond. And, going back to what Dirk said, I see that like the equivalent of, for a developing country, saying we want to industrialize. So we want the central banks to favor credit to industry, to manufacturing, or we want to develop agriculture. It's not at all, obviously, targeting individual companies. It's a sort of broad direction of development. Yeah. And so there's nothing impossible in that. You can conceive the role of a central bank of having this kind of role of triggering a change of direction in the economy as a whole. The thing is that it's not in the current mandate of the central bank, and it can conflict with the current mandate of the central bank. So, there is a political issue behind. So what I'm saying is, it's good that the ECB moves, it's good that the ECB experiments, but at some point there needs to be constitutional political validation of what they're doing.
Exactly.
So Jean, do you mean that at some point they need to revise the mandate of the central banks?
There are various ways. I mean, you could consider Parliament and the Council finding a way to support this move without giving instruction, because obviously giving instruction would be contrary to the treaty. And you can envisage amending the treaty, which is, we're speaking of something of at least a 30-year issue, until 2050, if we reach the goal of complete decarbonization in 2050. So we're not speaking of a sort of short-term goal. So it would make sense in principle to go back to the treaty.
And now it gets interesting, because I think we all agree the game changer in the euro crisis was imposing the banking union. And that was really a decision of the policymakers. And that's also what Draghi acknowledged when the council did the banking union, which was a political decision. Then he came afterwards with his statement, "We do whatever it takes." And so I agree with Sean that the first mover should be the policymaker. And I think with the EU Green Deal, the Commission and the Council and the European Parliament have made a clear choice. And now on the back of that, the ECB is aligning with that, not taking the lead, just aligning. And I would not say it is only the ECB. If I come back, Gisette, to your earlier point of leadership, it is about leadership. Companies who do it, they have CEOs who really are active. I see it now happening at the IMF, the new leader of the IMF and the old leader, Christine Lagarde, also saw a role for the IMF there. And the same you see now with the ECB taking on the role, like Draghi, with the statement, whatever it takes, took the political role to protect the euro area for the ECB. That was his leadership. So in the end, it is about mandates are shaped by people rather than the other way around, I would say.
Dirk, I have a couple of questions about what you're saying, like the championing on one side and another aspect on the practical implementation of what you propose with the tilting and so on. First of all, do we have other central banks? I mean, we already heard from Rebecca about the different approach that there is in the US. Do we have other central banks across the world that might have started to experiment some of these tilting that you are discussing about?
No, I think Europe is at the forefront, like with the Green Deal. You see a lot of pressure in UK. In the Parliament, the Bank of England has been asked to stop financing oil companies. And that's basically an exclusionary approach. And I think the three of us more or less agree that this kind of industry sectoral type of decisions are more political. So you see movement in some countries like the UK where there's pressure on the central bank to stay away from certain sectors. And my approach is an in-between one, where you would not move away from oil, but reduce your allocation. And so far, central banks have not experimented with that. So it is really a new idea.
So we are kind of uncharted territory also about the effects and the impact that those kind of measures can actually bring into, I mean, the effects that these policies might have in the end of the day on decarbonization.
Well, we should just a little caveat. If you look at the central banks in developing countries, obviously they don't have the same problem. The PBOC, the Central Bank of China, is not shy, intervening in the credit allocation because that's what it does anyway. Or the Central Bank of India. So we're speaking of a problem that's specific to the countries that have assigned to the central bank a very precise mandate.
Yeah.
Clear to me. We are coming towards the end of this episode, and I would like to hear Rebecca because I think that she has quite a few more points to make. And then after, I would like to go towards a final round of comments.
Thanks. I'd just like to take a minute to talk about central banks as bank regulators, which is a role that they seem to have coalesced around, particularly in Europe since the financial crisis and the start of the banking union, which the Federal Reserve has been doing in the US for a long time, and the Bank of England has been doing for a long time. And looking at climate as a bank stability and a market stability situation there, you have a real question of how much do you build it into the basic safety and soundness prudential regulations. On the one hand, climate is a big deal. On the other hand, money laundering is a big deal. Other sorts of things are a big deal that aren't necessarily considered part of classic safety and soundness regulations for banks. So at the same time that the central banks are deciding how much they're going to allow climate to influence their monetary policy operations, if at all, whether that's through requiring disclosures, whether that's through choosing how to sort of maybe nudge the balance in the bond market. You've also got a different situation where they're looking at the banks who are providing all this credit to the bond market and deciding how to assess their risk, deciding to assess what kind of regulatory capital they need to have in mind. So looking at all of that, we see that in the US, the move is very much towards pushing the banks to monitor it themselves, pushing the banks to make their own decisions based on their own boards of directors, how much they want to make the climate transition a priority and how much they're comfortable sticking with a business model that might focus on the old ways. In Europe, by contrast, there's this active effort to stress test the banks for exposure to climate and by extension, the climate transition. So by extension, saying banks need to look at moving their credit portfolios around. That's a really big difference in terms of taking an activist role versus watching and waiting and just trying to keep a handle on stability threats.
Yeah, Rebecca, you point out a quite important point, and a follow-up of this is like, are we completely reopening the Pandora box of the mandates of the central banks in our systems? That's the question. Like, if climate change is important, are we going to open it up also for other considerations? And you, Jean, in your piece, coming back from, since we are towards the end, and coming back to the quote I did at the beginning to your column, you point out also another aspect, which is not the subject matter of this episode, but somehow it is related to this conversation we are having and related with what Rebecca said, which was inequality and the fact that Fed in the US has expressed themselves explicitly on that side and how to fight inequality from a central bank's point of view. Are we really seeing a tectonic shift here on the roles of central banks on society matters?
It seems to me it's unavoidable that we're having these debates, and they're important from both from a technical viewpoint, from a sort of economic management viewpoint, but also from a democratic viewpoint. We have powerful institutions. They were at a certain moment in history, especially I'm speaking more of Europe, but beyond, many emerging countries, they were given a mandate with a very strong focus on something that looked like a major threat, inflation. The situation is evolving. The perception of threat in society is evolving. I'm not saying that inflation is gone forever, but for a decade it hasn't been a threat, or a decade at least. So inevitably these questions arise, and inevitably we have to have these discussions. What I'm saying is that you have both to sort of let the central banks experiment, go in a certain direction, but at the same time be very careful that they're not deciding by themselves what's good for society, because that would be very strange, to say the least, from a democratic viewpoint. An institution that has received a mandate to fight for price stability, deciding that climate change is becoming a sort of a major, possibly overriding objective. What does it mean from a democratic standpoint? And so we have to be careful in the relationship between the parliament, the principles, which in Europe are the member states, the institution, in the definition of the mandate, while, leaving room for experimentation.
Indeed, and I think this balance between the room for experimentation and stay within the limit of the mandate and the democratic system that you are in is going to be the challenge of what we are going to see in the next months or years. And just to conclude, Dirk and Rebecca, do you want to have some final reflections from your side as well?
I would like to pick up on this experimentation of Jean. And in my proposal for tilting, I also propose to do it in small steps so you can observe what the effects are of the new policy. So do it step by step. And what is really exciting, and that's what the transition I see in Europe, that we see climate change as a risk, and negative is always difficult to motivate people, to see it as an opportunity. If we move in new ways, for example, we move short-haul flights to the train network in Europe, the European Bauhaus, we create opportunities. So we see climate change not only as a risk, but also as an opportunity of new ways of working, where the ECB, like everybody else, can participate in. And then the debate becomes also more interesting to see it as an opportunity.
Absolutely. It seems to me quite an exciting moment to be working in a central bank at the moment. For the first time, there is real experimentation going on beside the firefighting that we were saying before, that after 2008 has been going on. Now there is like something that is looking forward to the future, not just trying to keep going somehow within a frame that is super difficult, because we are in a global pandemic, we are in a global crisis. So that makes it even more challenging, I suppose, but nonetheless more interesting. Rebecca, final words from you?
To be fair, firefighting was very exciting. Firefighting was a lot of very late nights. I think we can make a very good case that during the global financial crisis and the euro crisis, the central banks really did save the world. And that's something where all the people who worked on that can be very proud of that. Going forward, I see it as more of a shifting within the existing mandates rather than a broad new mandate. When looking at banking regulation and how to assess climate risks, or in the US, looking at how to weigh the inflation mandate against the employment mandate, the Fed has always had a dual mandate. But in the 80s, when inflation was really high, people sort of lost track of the employment side because they were so focused on getting inflation down. Now, and certainly for the past while, we see a situation where unemployment really is the problem and a consensus that the unemployment figures have not been reflecting what's really happening in the general economy. So I see the Fed's recent shift as a way of strengthening its focus on that side of its mandate rather than branching into some sort of new territory. With climate, if the EU is as clear on decarbonization as it seems to want to be, the ECB has a really good case to make for just falling in behind that and adjusting its policies to support that transition. Outside of Europe, each country is going to have to make its own decisions about how that ties into the fundamental stability of their economy going forward.
Thank you, Rebecca. And unfortunately, we have to stop the conversation now, even though we could go on, and for sure we are going to continue this conversation because we are going to continue the conversation both on green finance, on central banks, and in general the broad consequences of the climate emergencies on policymaking and economics. So this brings us to the end of this episode, and I would like to thank everyone for joining in the Sound of Economics. And I would like to remind you that you will find the link in the show notes for the 3 articles written by Jean, Rebecca, and Dirk, respectively, which we mentioned in this episode. And you can access all the analysis by our scholars on our website, www.bruegel.org. Until next time, bye-bye.